Welcome to Mali Investment Talks. My name is Joseph Areu, your investment advisor. Those of you who have followed me, I speak on a range of topics regarding passive investing. Those topics include treasury bills, treasury bonds, unit trusts, money market unit trusts, shares, you name it. You're welcome once again, and always remember to subscribe, share my videos, and make sure that you keep tuning in. Today, in this particular video, I want to talk about interest rates. You know, interest rates is the one factor that is probably the best predictor, the best determinant of your returns, the returns to your investment, okay? How much profit you're making out of your investments are probably best determined by interest rates, especially if you are investing in securities, such as we shall be talking about. At the time I'm talking to you, interest rates are generally low, or they are coming down. If you've been following many central banks, the Central Bank of Kenya the other day reduced rates to, I think, about around 10.5, 10.7%. The Bank of Uganda has reduced rates down to about 9 point something percent. So rates are generally coming down. The question is, what does that imply for your investments? So we want to talk about the impact, the implication of low interest rates on your returns as an investor. Next time, we shall talk about high interest rates, but for this time, we want to talk about low interest rates. And to start with, I want to talk about low interest rates and its impact thereon on treasury bills and treasury bonds. So if you like, on fixed income. So interest rates, in this case low interest rates, will affect your investment or the returns on your investment depending on whether you are investing in, number one, existing bonds or treasury bills. So these are bonds or bills that were issued in the past. Now they are being reissued. In Kenya, for instance, you will hear something called tap sales. So when in Uganda we talk about reissue of bonds, in other countries, I'm sure you will hear similar terminologies. So what does a low interest rate environment mean for an existing bond? It essentially means that the price of the bond will go up, because now you are buying a bond which was issued in the past at a high yield. Okay, remember the yields are now coming down, interest rates are coming down, so there's a high likelihood that an existing bond has a fixed but high interest rates than what is prevailing at the moment. So the demand for those bonds will be higher and their prices will tend to be high. So if you have such a bond, if you want to sell it, this might be the time to sell it, because you are going to sell it at a high price. All right? If you're buying such a bond, then you need to be aware that the price is going to be high. The other category of bonds and bills, though, would be new bonds, or new bonds and or new treasury bills. In that case, the yields are going to be a bit low, in consonance, if you like, in tandem with the current interest rates. So when you're buying a new bond under the current interest rate regime, just be aware that the yields will be rather low in tandem, as I said, with the current interest rate regime. So every time the central bank reduces interest rates, you can be sure that the bonds that will be issued at that time will also attract reduced rates, if you like, coupons. The coupon rates will be low. So that is something that you want to be aware of in terms of the impact of low interest rates on treasury bills and treasury bonds. Next, I will talk to you about the impact of low interest rates on other securities. For now, thank you very much. Remember to subscribe and share the videos within your communities. Thank you for listening and watching.